The 10-period moving average is a technical indicator, and we use it to identify trends in stock prices and other financial instruments. It is calculated by simply taking the average of the price over 10 periods, and it could be intraday to monthly charts, it doesn't matter. And with this moving average, we can actually use it to identify support and resistance levels, as well as potential entry and exit points for trades. So for example, if you're looking at a chart here with daily data points for Apple, then your 10-period moving average would be the average closing price of the last 10 days. As long as those closing prices are higher than the previous day, the average is going to continue to trend upwards. We can also use it to help us decide when it's the right time to enter or exit a position. So if there's an uptrend present, this could indicate that prices are likely to continue increasing over time, and buying is probably the best trade to take. If there's a downtrend present, well, this is going to suggest that prices will probably keep decreasing, and selling out of the position or just selling may be advantageous. But when price whips back and forth over the average, as we see in the middle of the chart, you just may want to avoid trading that ticker. They may also be useful for traders by helping to identify support and resistance levels within the markets. Now, support levels occur when buyers come into play, pushing up against sellers, but also prevents further declines in price. Resistance levels, well, they occur when sellers come into the market, pushing down against the buyers, and that prevents further increases in price. So when we use a moving average like the 10 period, traders can see points where price may reverse from. Now listen, the average does not provide actual support or resistance, okay, but it does give you a framework to help identify support and resistance to the left of price, as you can see here. So how do we calculate a 10 period? Again, it's pretty simple. We add up all the closing prices of the last 10 periods, divide by 10. And as each new period ends, we drop the oldest period's closing price, add the latest period's closing price, and get a new moving average. And that's just for the simple moving average. There's other options like the EMA, the WMA. There's other ones out there. How do we add it to our chart? Very simple. Select moving average from your list of trading indicators in your platform. This is TradingView. Enter 10 as the period. Boom, it's on your chart. Very simple. Now, like I mentioned, the 10 period, it's just a simple calculation, right? The closing prices for each bar on the chart, depending on the period you select. But most platforms are going to allow you to select different types of moving average. Exponential moving average are often used, but just keep this in mind. The more complex the calculation does not mean you're going to find better results. Okay, there's absolutely no magic number. There is no best number when you are determining the average length to use. So I mentioned the EMA, and along with the SMA, these are the two most popular ones. The EMA, it just gives more weight to the recent data points than the older ones. Okay, so this just means that the prices are going to change quicker than an SMA. So the way in which these two averages are calculated is different, right? Obviously. So the SMA is going to take all the data points within a given period, divide them by their total number in order to calculate its value. But the EMA uses a different formula, assigns greater weighting to recent price movements. Okay, different. You can see it. So here, this chart has three different 10-period weightings. We have the SMA, we have the EMA, and we have the WMA. Now let's be honest. Is there a big enough difference between these three that would drastically alter your trading strategy? And if you say yes, then your strategy is not very robust. But here it is. When it comes down to personal preference, because they all have their advantages and disadvantages depending on the strategy that you're using, just keep in mind EMAs are going to give you a quicker signal, but they can also produce false signals just because their sensitivity towards sudden price fluctuations like a gap or news releases. So here is the 10-week and the 50-day moving average, and they're generally going to look the same on your chart. These are two popular ways to use averages, a 10-week and a 50-day moving average. Again, the 10-week is just going to use a data set of 10 weekly closing prices. The 50-day is going to use 50 daily closes. Now this vertical line here, it actually represents the same time period of the 10-week average on the left and the 50-day on the right. Both represent the change in trend direction pretty equally. Any difference is pretty negligible. It's going to come down to your preference. Here's a strategy. And the good thing about the 10 period, really good tool to find consolidations and breakouts. And that's a viable trading approach. So if the last 10 trading days has little movement, you're going to see the average catch up to price. And this is a really good quantifiable way to find consolidations. There's no guesswork. So when you're trading consolidations, you want to see a strong directional move in the instrument. And then you want to see price consolidate. So a general rule, just look for it to consolidate to at least around the 10 simple moving average. Now your trade can take different forms. You could take a entry on the reclaim of the 10 period, break of a swing level, break of the highest high prior to consolidation, or just a failure test of a support level. Your stop loss would go below the low of the pattern. Your take profits could be a multiple of risk. That's known as R multiples. And when there's a discrepancy between the price action and the 10 period SMA, it could be indicative of either an impending trend reversal or a continuation, right? Just depends on the positions. So for instance, this price is making higher highs. The 10 period SMA is starting to trend downwards or it's going flat. Well, this could suggest that momentum has shifted. We might expect to see a bearish move downwards from the current level. On the flip side of that, if prices are creating lower lows, but our average is starting to flatten or flip up, long trades may be the best trades to take. Another strategy, use the 50 SMA for trend direction. Look for pullbacks to the area around the 10 period. Now the 50 SMA, that tells us we can only take buys, okay, as price is not only above the average, but also the average is sloping to the upside. Price pulls back to an area around the 10 period. When that happens, look left for prior resistance that could now be acting as support. And then traders can use entry techniques that they're comfortable with. So if price does not move too far away from the short-term average during an uptrend, well, we know there's a lack of momentum to the upside or there is building interest to the downside. And if price gets too extended from the average, well, look for an instrument that's a little bit closer to the 10 period. So people always ask, what's the best average? There is no best average, okay? Generally though, shorter periods like the 10 and 20 days, they're better suited for short-term strategies, day trading, scalping. Longer periods like the 50 to 200, long-term strategies like swing trading and position trading. There's just a whole bunch of numbers that you could use that line up to your strategy. The 20, the 50, the 100, and the 200, those are the most popular averages. I just want to experiment with them. That's all. Using 10 days for the average length, I think it helps traders understand price action, helps identify trends and momentum. You can use an EMA, you can use an SMA. Don't go down that rabbit hole looking for the best one because there's really little difference also between the 10 period weekly and the 50 period daily moving average, right? Just whatever you prefer. And we're talking about indicators here. We have a free indicator blueprint. You can learn about moving averages, counter channels, stochastics, MACD, the truth about these things. And people charge $97 for a course like this, but we give it to you for free. The link is in the description below or off to the left here. Thanks for watching. Hit like and subscribe. We'll talk to you soon.